Imagine being able to legally use your losing investments to save money on your taxes this year. That's the power of tax loss harvesting. It sounds fancy, but it's one of the simplest ways to cut your tax bill without filling out extra forms. I'll break down what it is, why it's totally legal, and the one rule you cannot break. So, what is tax loss harvesting? It's an active strategy you use in taxable brokerage accounts. Think regular brokerage. Let's see how it's done. You sell an investment that's down to create a loss, and you use that loss to offset taxes on a different investment you sold for a gain. Picture this. You made $5,000 on a stock this year, but another stock is down $3,000. The harvest move? Sell that loser, lock in the $3,000 loss. Result: that loss cancels $3,000 of your $5,000 gain, so you only pay tax on $2,000. That's real money back in your pocket. Why do people do tax loss harvesting? There are two big reasons. First, to reduce capital gains tax. Losses offset gains dollar for dollar. If your harvested losses equal your gains, your net capital gain is zero, meaning no capital gains tax for the year. Second reason is to reduce ordinary income. If you've got more losses than gains, the IRS lets you use up to $3,000 of the leftover loss to offset your salary or other ordinary income this year. In a high bracket, that $3,000 can save you hundreds or more. Now, if your net loss is bigger than $3,000, say $10,000, you can carry the extra $7,000 forward to future years to offset gains later. Now, the trap that ruins everything, the wash sale rule. If you sell a security for a loss, you cannot buy the same or substantially identical security within 30 days before or after the sale. Do it, and the IRS disallows the loss. You lose the tax break. The fix is the smart swap. Sell for the loss, then immediately buy something similar, but not substantially identical, so you stay invested. Let's take an example. You sell S&P 500 Index Fund A for a loss, and you buy S&P 500 Index Fund B from a different provider. Same index exposure, different fund. After 31 days, switch back if you want. So our final takeaway is that tax loss harvesting is about timing your sales to minimize taxes, turning a dip into an advantage. If you have a taxable brokerage account, consider doing this before year end.